Welcome back to another edition of Intelligent Investment Today, the podcast concerned with the art of value investment. Each episode we discuss various aspects of the craft, borrowing from the principles laid down by the man widely considered to be its founding father, mentor and teacher to Warren Buffett. We're of course talking about Benjamin Graham. In today's edition, we shall be highlighting some of the behavioural traits that are a prerequisite in successfully implementing value investment. We shall be doing this partly through comparing how value investors behave as in contrast to speculators, and through highlighting real-life examples of both how to behave and how not to behave. We shall discover how the investor acts and behaves is every bit as important as a selection of the right stock. Without the right mindset and behaviours, the value investor is doomed to fail no matter how skilled they are at identifying undervalued stock. So sit back, grab yourself something caffeinated, and get ready to add one more building block to the wall of value investment knowledge. Sometimes in life we can learn the most from other people's mistakes and faulty behaviours. And never has this been more true than with the GameStop debacle. If a teacher of value investment wanted to invent a story to really highlight the perils of speculation, then they could do no better than the story of GameStop. The only problem might be that it would seem so far-fetched and unlikely that nobody would believe it. The background to the story is quite well known, but I shall briefly describe it to those who may not be fully up to speed. The GameStop saga began in around 2019. The business, a US video game retailer, which was once the go-to destination for game-orientated youth and adults, had begun to lose favour throughout the previous decade as customers increasingly made purchases online, abandoning GameStop's store operations. By 2019, the business was really struggling, and hedge funds and institutional investors had begun to bet heavily on its demise. This short selling caused the share price to tank further still. When the COVID-19 pandemic struck, it seemed GameStop's fate had finally been sealed. But then something quite bizarre occurred. A new generation of investors, and I use that term very loosely, who due to the pandemic were armed with stimulus money and unemployment checks, as well as plenty of free time on their hands, began to buy up the stock. The decision to buy was not based on any form of analysis by the investors, but rather what they had read on the online forum Reddit. The stock soon became an internet meme that was rapidly copied and spread by online users. The influx of people wanting to buy the stock caused the price to rise from about $6 at the end of 2019 to around $17 a year later. But we had seen nothing yet. By January 2021, the stock price reached a peak of around $500, around 85 times its price from just 2 years previous. The volatility continued as the stock price plunged a few days later to $90 and then to $50 before recovering to $265. Let's look at this another way. A business that was valued at around $200 million went on to be worth around $20 billion. The problem was, of course, nobody stopped and asked themselves what the business was actually worth. Of course, a valuation would have been quite possible, but the problem was nobody bothered looking. The vast majority of these investors were, remember, strictly amateur, in that they had no experience in investment whatsoever. They were copying the same old mistakes people had made 20 years previously, during the dot-com bubble, and forgetting to ask the simple question of how much. They were relying on the advice of other amateurs on Reddit forums who were telling them that no price was too much to pay for a company like GameStop. So if these amateur investors had have been trained in the art of value investment, what would they have discovered from the accounts of GameStop back in 2019, had they indeed bothered looking? They would have found a business that had gone through a couple of really bad years, but prior to this the business had a strong record of earnings. The balance sheet showing wasn't great, but neither was it the worst I've seen. The most pertinent question was a qualitative one. Was the current downturn a temporary blip or one of more permanent order? But nevertheless, it was certainly a business that could be invested in, at the right price of course. But what was that price? Based on the earnings record of the previous 10 years, I would have placed a preliminary valuation of $4 billion on the business. The big shadow of doubt hanging over it, however, was the prospects for bricks and mortar retail stores, with strong evidence at the time that console sales were migrating to the online retailers and physical video game sales shifting to downloadable and streaming formats. As a value investor, I would have had to have decided whether the evidence is damning enough on this score to completely invalidate my quantitative conclusion. Sometimes trying to predict the future in this way is a near impossible task, as there are far too many variables involved. What seemed clear was that the retailer would need to alter its business model, game sales would likely be decimated over time, as faster broadband connections do away with the need of discs to install. The business of selling games and associated gaming paraphernalia need not be lost completely to internet retailers, however. Online and bricks and mortar retailers are a very different proposition from one another. The high ticket price for these items does away with some of the advantages held by the online retailers. Many people making such large and hefty investments will likely want the local support and security a physical retailer can bring. They may want to avoid the risks associated by a heavy-handed or light-fingered delivery driver, for instance. And if things go wrong, they have expert and friendly advice close at hand. In short, the better deals available online will not necessarily sway customers away from a local purchase. In short, I would likely have come to the conclusion that this was previously a strong and attractive business, but the market in which it operated had altered dramatically. This would clearly require a change in business model that leans less towards the sales of games and more towards the sale of consoles and other gaming paraphernalia. This does not seem beyond the wit of a capable management team to carry out these necessary changes to the business model, but it also places a big question mark over the initial quantitative valuation that I arrived at. I would therefore demand a significant margin of safety, probably to the tune of 50%. $2 billion would therefore be the top end of what I would have been prepared to pay for GameStop at that time. Bearing in mind that at points in 2019, GameStop was trading at less than a quarter of that value, then it did appear to be somewhat of a bargain. So to conclude, we can say that at certain points in 2019, the market did seem to seriously undervalue GameStop, based on its past account history. But it would appear that the fact it was genuinely undervalued created this internet meme that rolled on, with people forgetting that a stock can be undervalued at one price and overvalued at another. At some point, GameStop stock entered the greater fool territory of investment. It ceased to be a business, and the stock became a unit of currency in itself, similar to what we see all the time with cryptocurrency. The greater fool theory goes that a lesser fool might buy an asset at too high a price, but so long as there is a greater fool, they can still make money from their investment. At some point, of course, this cycle hits the wall, and the biggest fool is left carrying the can. As far as GameStop is concerned, the greater fool theory is still going strong to this day. Whilst the market capitalisation has dropped from its dizzying heights of around $20 billion, it still hovers at around $9 billion, despite having made big losses since 2019, with only the most recent financial year showing a modest profit of about $7 million. As far as what I'd pay for the stock today, I'll stick with my original $2 billion. It is clear that value investors, at least ones following the Benjamin Graham approach, would never get sucked into a trap like GameStop, unless it offered discernible value that can be counted. We might pillory the masses who invested and continue to invest in GameStop and consider them some sort of investment Neanderthals. But remember, many very serious professional investors often make investments without remembering to ask how much. As with your grocery shopping, value investors like to know exactly what they're getting for their money before taking the item to the cashier. And if you keep that thought in mind, you'll likely succeed in your investment goals. That's it for today, folks. I hope you've enjoyed the show and can appreciate how the GameStop saga is a perfect example of how the masses can act irrationally. The fear of missing out and seeing others get rich on the back of a meme stock is a powerful driving force of people to continue to invest in stocks that they have no way of knowing the value of. The GameStop saga rumbles on, and we shall see in time how it pans out. Thanks for tuning in. I say it every time, but do consider adding us to your playlist if you've enjoyed the show, in order that you'll be alerted as new additions land on your platform. I'm David Coombs. This has been Intelligent Investment Today, and until next time, stay safe and happy investing.